Okay, so what I want to do today, and probably much of tomorrow, as I mentioned, is I want to do kind of more going through some case studies, which will hone in on our knowledge of DCF. It's also going to hone in our knowledge of pieces of how the model comes together that we've been learning up to this point. So it's good practice, it's good review. And how I want to begin is, and so what I'm going to do is, for the guys online that might be watching this, I'm not going to record the whole thing. I'm going to record the case, and then we're going to go through the answer, and I'll record pieces of the answer so you can kind of follow, but it doesn't make sense to obviously record and watch while you're sitting kind of struggling through it and while we're talking through it. So what I do want to do is, let's imagine that this is an interview, right? This is an interview. You're sitting in front of an associate. There are a couple ways this can go. I can hand you a piece of paper with a couple of assumptions. That's the way the exam is going to go. Or we can have a conversation, and the conversation will help me understand how you're thinking about this. So let's do that. So I'm going to start by saying that we are working in a boutique M&A firm. We have a company. It's a new client. We're going to pursue, we have to put together a pitch book pursuing some strategic alternatives. This is 90% of what you'd be doing at a bulge bracket bank. We want to know how to approach them. So the first thing we want to do is analyze the business. We want to value the business. So my question is, what do you need to know from me to be able to determine this value, this business value? So, I mean, what we had done was talk through, as if this was a one-on-one interview, what the assumptions would be to complete this valuation analysis. So the point was how to question me through assumptions in proper order that proves to me that you have an appropriate line of thinking to be able to handle a bunch of assumptions and build a DCF analysis. So you guys did a little out of order, but we'll do it again. And the point is, it's very easy to get familiar with a firm's model and template and just update numbers, right? So that's why we do case studies as exams from here on out. So we talked through it, came up with a bunch of assumptions, and I want to slowly step you through. This is meant to be, this is designed off of a 45-minute case. And I'm going to kind of step you through the process a little bit. And then as we practice this day after day, I'm going to kind of pull away and hopefully you should be able to do the whole thing independently. Then you're ready for the exam. Right? So at this point, where's my OneNote? Okay. At this point, you should have a light framework for a DCF analysis. I'm going to do it with you on paper. How do we build a DCF? What do we need? Because how do we get to that cash flow?
We're going to pass on that one.
You're going to pass. Anybody else? Oops. Nobody knows? Somebody knows. Nobody knows how to build unlevered free cash flow?
I don't know if it started with EBITDA or EBIT.
Okay. I mean, you could do it either way. Oh, there you go.
But then I have some that changes the working capital.
So let's do this. So we're going to start with EBIT. Okay. EBIT. Then what?
Some depreciation and amortization.
DNA. What else?
Changes in working capital.
What else?
Deferred capital.
What else? Deferred taxes. Deferred taxes. Working capital. CapEx. What else? Taxes. That is unlevered free cash flow. Okay? So, start to build this out. Okay? Using the assumptions given. Okay, let's take it one step further. I'm going to insert a row. Insert above. Okay, for EBITDA. Okay, EBITDA I had given you as 100 million, growing at 5% a year. So year 1 is 105, year 2 is 110.25, year 3 is 115.763, year 4 is 121.551, year 5 is 127.628. That's EBITDA. Now what? You got to get EBIT. How do you get EBIT?
Subtract the EBITDA.
Subtract depreciation. How do we get depreciation? On what?
On CapEx.
On CapEx.
Yes.
What's CapEx?
5 million?
Nope.
I thought it was 5% of EBITDA.
5% of EBITDA.
Yes. Oh, wait, I thought we had EBITDA, wait, sorry, I must have missed something. I thought EBITDA was 100 million.
Yes,
And that's
LTM.
12 months, so we're projecting for the next year.
Yeah.
The next year. Okay,
Yep, this is year 1. Okay, so CapEx 5% of EBITDA. Okay, so 5.25. I'm gonna put negative things in parentheses. 5.513. 5.788. 6.078. And 6.381. Okay? It's different when you think about it this way. Okay. What else? What else can we do?
Now calculate the depreciation.
Okay. Now you got to build depreciation on this. You got to build the depreciation schedule. Try it. 25-year useful life? 10-year. 10-year useful life. 10-year useful life on CapEx. No property. Build the depreciation. Straight line. Give it a shot.
Percentage of the growth rate of the EBITDA?
5. So, I want to build a depreciation schedule. Okay. Let me do it like this so it's a little cleaner. No. Okay, depreciation is going to be year 1, 0.525, right? All the way through. Year 2 is what? 1.5513, right? Year 3, 0.5788. Are you guys doing this? Getting this? Year 4, 0.6078. And year 5, 0.6381 total when you add them up. Okay, 0.525. You don't have to draw out the whole table. I mean, if I draw this on paper, I would just do this and draw an arrow, this and draw an arrow, because you know You're just adding this to this, and then here you're adding this to this to this, and here you're adding 1, 2, 3. You're taking this total and you keep adding. Actually, really, it's just this plus this. That's this, and that plus that is this, and this plus that. Because you just keep stacking on new depreciation. So the more you do this on paper, the more tricks you're going to learn to make this easier.
Why are we doing it by 10% of the CapEx for each one?
10 million, 10 years useful life.
10 years.
10 years useful life, so we're dividing by 10. So this is 0.525. Okay, and then that's 1.076. Okay, that's 1.655, 2.263, 2.901. Okay, and that will go up here. Okay, I'm not going to draw it again, but you know from below. Oops. Okay. All right. This is day 3 stuff. You should know this. Okay. So that means EBIT is the EBITDA less D&A. 104,475. 109, 174, right? 119, 114, 107. 119, 288. 124, 727. Okay? Right? You can also do taxes. EBIT times tax rate. Right? Taxes is 35,566. 38,211. 39,938. 41,751. 43,655. Okay? Let's take a look at straight line depreciation. Accelerated. So accelerated depreciation is based on 25%, 20%, 15, 12, 10. Okay? Year 1. Year 1 is what? $1.313, 1.050. Yeah? This is your 1.050. You didn't say that.
No, that's not. No, that's wrong.
That's wrong now. No, it's 1.050. It is for sure. How are you calculating this?
That's 5,5,5,1,3.
And
20%.
nope. No. How did you get this?
I didn't send you the capex 25%.
What's capex?
As first year,
Which is what?
which is 525.
525 times 25%. This is still year 1.
Yes.
Then it decelerates. So then it's 525 times 20. 525 times 15. Right? Okay? So 0.788, 0.630, 0.525. Okay? So year 2, what happens? Which can get you started. What happens in year 2? Or at all?
Year 2, I didn't come over there.
Okay, but let's just talk it out now, just so.
The year 2 will start from the next one.
Good.
And then we calculate for 20% of
25%.
25, sorry.
Start from the beginning.
Okay.
25% of 5.513,
Yes.
which is 1.378. And the next year,
20%.
good. Work on that. So this is the accelerated depreciation. Are you guys getting that? Do you have questions on that? No? Yes?
%, times 0.5513. Ew. Okay.
You okay? Then what? Difference. Difference is 0.788, 1.352, 1.682, 1.871, 1.965. Okay. And you multiply that by 35% to get the deferred taxes. Okay, so I'm going to put it up here so you have it, which is 0.276, 0.473, 0.589, 655, 688. Okay? Okay, so you guys should all be at this point working capital. Remember, I gave you the days. I gave you 30 days on AR, 15 on inventory, 25 AP, 10 accrued expenses, but I said to be simple, let's do everything off of EBITDA. Get working capital, get the cash flow, let's match it, okay? 30 accounts receivable, 15 inventory, 25 AP, 10 accrued expenses. Totally appreciate it. Okay, let's just, I'm gonna go down. Somebody wanted accelerated depreciation. There it is. Sorry, I missed that message. While you're looking at that, I'm gonna get you started at working capital, okay, where you have AR, right? How do you do AR? You forgot the formula? Is that why you're stuck? Okay, I'll get you started then. Easy. 30 days AR, 30 divided by 360 times 105, EBITDA. Equals 8.75. EBITDA, 8.75. Okay? Do that for each year. That's AR. Do it for inventory. Do it for AP. Do it for accrued expenses. Assets minus liabilities is working capital. This is where doing it on paper, you have a lot of people end up adding it all up and totaling it. That's a big problem on the test. Assets minus liabilities, you got to do the year-over-year change. Okay, when you have a template and you're throwing numbers in, you forget these things. So good. So work that through. Take a few seconds now. Right? Let's further this. Time's slipping away. Next. Wait a minute now. Right. Okay. We are going to need year 0 because we need to change from year 0 to year 1. So I'm going to do this. Year 0, year 1, year 2, year 3, year 4. I don't know if it's going to let me go out one. I'm going to insert a row to the right. There you go. Great. Year 5, okay? So year 1 is 8.75. Okay. Year 0 is 8.33. Okay. Year 2, 9188. Year 3, 9647. Year 4, 10129. And year 5, 10636. Okay? Then you got to do it for inventory. Got it? Inventory.
Why we got to year 0?
Where do you get it? What do you think? 100 EBITDA. 100 EBITDA. Year 0 EBITDA. Versus year 0 EBITDA. LTM. Because we want the change from year 0 to year 1 to get year 1 working capital. So inventory is 15 divided by 360 times 100, which is 4167. Okay? 4375. 4594. 4823. 5065. 5318. Okay? Accounts payable. 6944. 7292. 7656. 8039. 8441. 8863. Okay, accrued expenses is about 10 days. 2778, 2917, 3063, 3216, 3376, 3545. Okay? That's what you should be getting. Total working capital is not a sum. It's the assets minus the liabilities. Okay? You guys getting that?
You copied the accrued expenses and total.
Mm-hmm. That's the answer. What, you got something different?
Would it look exactly the same?
Yeah.
As the accrued expenses?
It's not a coincidence. Why is it not a coincidence? It is not a coincidence that the total is the same as accrued expenses. Because we did, for AR, we had, we had for AR what, 30 divided by 360 times EBITDA, right? What was inventory, 15? Okay. Inventory was 15 divided by 360 times EBITDA. What was AP? AP is 25 divided by 360 times EBITDA. And accrued expenses, 10 divided by 360 times EBITDA. Right? You see what I'm doing? Do you see what I'm doing? I mean, this is just what you do all the time, right? In reality, though, it's this times revenue, this is times COGS, this is operating, you know what I'm saying? But since it's the same denominator, you can just pull EBITDA out of everywhere, right? So you would just basically do 1 divided by 360 times EBITDA, right? With this, times what? 30 plus 15 minus 25 minus 10, right? It's a shortcut. What's 30 plus 15 minus 25 minus 10? 15. 10. So this also is saying 1 divided by 360 times EBITDA times 10. Or 10 divided by 360 times EBITDA. Not a coincidence.
I mean, for the numbers equal to like
Well, because AE is also 10 divided by 360 times EBITDA. Yeah. So in this case, you didn't have to do this. You could have just done 10 divided by 360 times EBITDA. It's a shortcut. But be careful on the exam. So I'm not going to make it that simple. On the exam, I'm going to give you revenue, and I'm going to give you things like that. I'll give you more complicated versions of this. But just in this case, total working capital is 10 divided by 360 times EBITDA. Just a little algebra. Okay? Question on that? Now, we got to calculate the change. So actually, this is not what goes into our cash flow, because if you go up from 277 to 2917, what impact does that have on the cash flow? What's the cash flow impact on that? Up or down?
This net, so that's an asset, so it's a diversified.
Down. Yeah. So the working capital impact on that is minus 0.139. Next year, minus 0.146. Minus 0.153. Minus 0.161. And minus 0.169. Okay. Now you have everything to build your cash flow. Get this out of here. Let me get this out of here. It's annoying. Annoying. Or 63.32, 66.854, 70.742, sorry, 472, 74,216, and 78,111. Okay. Getting this right will be 75 out of 100 points on that part of the test. And believe it or not, this is income statement, cash flow statement stuff. But I bet you didn't realize how much practice you need on income statement, cash flow statement stuff. I bet you figured you had that all figured out in week 1 or even before the program. It's going to take practice. It'll take practice. Okay, we got to discount this stuff. How do we discount it? Calculate the WACC. Let's calculate the WACC. Okay, so we calculate the WACC by taking the debt, which is 150, divided by debt plus equity, which is 250, 150 plus 100, times cost of debt, to give you a 7%, times 1 minus tax rate, which is 65%, right? That's 2.73%. It's cost. The percentages, I think this is correct. Next, equity divided by debt plus equity, 100 divided by 250 times cost of equity. Okay, we got to calculate cost of equity. What's the cost of equity? Beta times. And what's the market premium? Yeah, and what is it? What are the numbers? Then I give you. Yeah. Which is what? So 11 minus 2. Mm-hmm. 11 minus 2 plus 2. Order of operations. Let's get this. 13.5 plus 2. 15.5. Then you add it to the 2.73. Yeah? This is off because we're using percentages. This is actually 2.73 in percentage. Okay? So 15.5 plus 2.73 is 18.23. No, something's wrong.
What it's two? That doesn't put it in cost value, right? Tells us,
Three.
it's not weighted. It's not weighted. What?
Right. Sorry. This is the cost of equity. Yeah, I thought we were here. Sorry. There we go. 15.5%. Sorry? 6.2.
Add two, then.
So this would have worked.
Add two is, the two is risk-free rate, right?
What are you saying, Ray?
Nothing, I got it.
Okay.
Yeah, the formula sounds weird. It looks weird. Yeah, 2.5.
Looks pretty good to me.
I did ask you why you add the two.
Yeah. No. I'm going to put it back. I was converting into percentage units. I was converting from decimal to percentage because it was easier for me to see, but I realized that confused everything, so I put it back.
Just to confirm, you gave us the data and.
Yeah, those are given. Those are given. So 8.93. Yeah. So in other words, the 0.0273 plus the 0.062 is 0.0893. 8.93% is a discount rate. Okay? That is a discount rate. So we take each cash flow and apply the discount rate. The cash flow divided by 1 plus that to the power of the years. Have you done it? It gives you discounted 58.13, 56.342, 54.523, 52.712, and 50.93. Okay? Those are the individual cash flows. And then the sum of all those, you add them up, is 272,636. Okay? Now we got to calculate terminal values. So even if you don't have this, just because of the sake of time, try to calculate terminal values. Perpetuity method and EBITDA method. Good practice there. We'll keep doing these, until you have it. And it won't be that boring of this every time again. I mean, we'll do other things in between. Don't worry about that. Don't think, 2 weeks of this. It's not quite like that. Terminal value, how do you do it?
Cash flow times 1 plus.
For perpetuity, okay, want to do perpetuity method? So that's 78,111. So I'm going to do terminal value. Terminal value perpetuity is that 78.111 times 1 plus G, which I gave you as, did you ask that?
No.
Nah, that's the one you didn't ask. Yeah, there's one assumption you just didn't ask yet. I thought I gave you 1%. I mean, I thought I had 1%. 1 plus 1%, okay, divided by the WACC, 8.93%, minus the 1%. Okay, 994.8564, okay. I'm just going to go ahead and do this for the sake of time so it's recorded on the thing, and then tomorrow we'll do one all over again. Hopefully you'll be a little bit more efficient, a little bit. I don't mean that to be sarcastic. It's going to take little steps. And then don't forget, we have to discount this. Divided by 1 plus the discount rate to the power of 5. 6486686. That's the present value of the terminal value, yep. And then you got to add that back to the sum of the cash flows. Plus the, what do we determine that as? 272,636 plus 272,636 equals 921,3046 is the value of the business based on the perpetuity method. And then we got to do it based on the EBITDA method. How do we do it based on the EBITDA method? Final EBITDA, which is what? 127,628 times 7, which is given 893,396, and we divide that. We discount that back. 1 plus 893% to the power of 5, which is 582,514. And you add the sum of the cash flows to that, and your value is 855.15. So your value is somewhere between 855 million and 921 million, depending on perpetuity versus EBITDA. That's the value. That's enterprise value. Stop there. You could subtract net debt if you want to get equity value. No, I wouldn't. For the test, things like that, I'd stop here.
What happened to the income? Do we have to do that?
If they ask, sure. If they ask, you could say no. But again, it's great reflection on core income statement, cash statement mechanics, how the depreciation schedule works, how the working capital works. It practices a lot of skills. Looking at it this way, you probably don't realize there's a lot more practice you need to do. So we'll do a couple other things tomorrow, but we'll do another one of these. I'll give you back the tests. You guys did pretty well, actually. And I'm not just saying, I mean, I'm honest. The last group did really bad, and I said they did really bad. And I was nervous. I said I was nervous. I'll be honest. But you guys did pretty well. A few things you kind of botched up, but. Okay. See you tomorrow. This will be uploaded. You're welcome.